You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. Crude oil prices have stayed under $100 a barrel the last 2 years, a notable achievement considering two major foreign wars and the unpredictable fluctuations in global demand. The ability of American firms to flexibly increase production has made the U.S. the world's largest oil producer, a significant contrast to a couple decades ago when our dependency on foreign oil was a top national security concern. On today's episode, we talk with Bryan Chapman, Market President for Energy Finance with First Horizon, about the most important forces impacting the oil industry today, what drove the remarkable transformation of the U.S. oil industry over the last 20 years, and how oil firms are thinking about the future. Stay tuned. Coming up soon, our interview with Bryan Chapman, Market President for Energy Finance with First Horizon. But first, a quick market update. Treasury yields maintained their post-CPI rally during the last 2 weeks, moving within notably narrow ranges through a handful of appearances from Fed officials and data surprises. The long end of the curve drifted upward on Wednesday as traders began positioning for the end of the month and quarter, but eventually rallied after some weaker than expected data yesterday. This morning's PCE report showed the headline PCE price index was unchanged in May, in line with the consensus expectation, and the core PCE deflator rose only 0.1%, also as expected. The encouraging inflation data is exactly what the Fed wants to see, but it will take at least a few more months of similar reports for policymakers to consider a rate cut at the September meeting. Personal income rose 0.5% last month, while personal spending rose 0.2%. Last week, May retail spending came in weaker than expected, showing monthly gains but not nearly enough to make up for April weakness. We think, however, the data were actually stronger than they appeared on the surface. Because the data are reported in nominal dollars, the underlying strength can be distorted by price changes in each spending category. Using component-specific deflators from the May CPI, we estimate inflation-adjusted retail sales grew 0.44%, much more encouraging than the headline 0.1% increase. The Treasury auctions for 2-year, 5-year, and 7-year notes went off with few issues this week. Given the narrow ranges of Treasury trading the last couple weeks, we weren't surprised to see that the auctions solidified existing market pricing rather than established any new direction. That's all for the market update this time. Now, our interview with Bryan Chapman. Our guest today is Bryan Chapman, Market President for Energy Finance with First Horizon. Bryan, thanks for coming on the podcast.
Thanks for having me.
Our topic today is the oil market, how to understand the key forces driving oil prices now and in the future. Bryan, we hear a lot about the price for West Texas Intermediate crude oil, WTI, but every now and then you can read about Brent or a variety of other types, and they usually have different prices. So what are the main types of crude oil, and how do they differ from each other?
There are many different types of crude across their physical properties and chemical properties, even their color. It can range from being almost clear to tan to yellow to brown and black. And the crude can either be very light and sweet, which means it's got very high viscosity and very few impurities. It can also be really heavy or sour with very low viscosity and high levels of impurities like H2S. The grades of crude can be really different in different areas around the country and around the globe due to local supply and demand factors. And because the different types of crude can only be run in certain types of refineries. And those refineries will generate a different mix of refined product depending upon the type of crude that they run. I'm sure everybody is familiar with the list of refined products included common things like gasoline and diesel fuel, but it also can create manufactured jet fuel and heating oil, liquefied petroleum gases like propane and butane, naphtha, which is used as a petrochemical feedstock or as a solvent, different kinds of lubricating oils, asphalt, petrochemical feedstocks that are used to manufacture plastic, synthetic rubber, residual fuel oil, which can be used in power plants and ships, and petroleum coke, which is really used in the steel making process or as a fuel in a power plant. All these products trade at different prices in different local markets depending upon supply and demand.
So when there is a difference in crude oil prices, let's say there's a difference between West Texas Intermediate and Brent. I understand that they are different viscosity, different properties make up the specific crude oil types, but do they have different uses? I mean, is oil just oil? If I'm someone who just wants a gallon of gasoline to drive my car, is there any value difference between these different types of crude oil?
Typically, the differences between these different global benchmarks is reflective of a couple of different things. The quality of the various crude, since not all refineries can process all the grades of crude, and transportation costs. You can also have things like local taxes and environmental regulations can have an impact. An example of that is why the cost of fuel in California is so high. You can also have prices negatively impacted by things like sanctions. After Russia went into Ukraine, the West was really not interested in creating an energy crisis by banning and sanctioning Russian crude. Really, what they were interested in doing is reducing the amount of money that they earn from selling that crude. And of course, China and India were very happy to purchase that crude at a discount. There's all kinds of factors that can impact those prices, but pretty much any grade of crude can produce your standard gasoline and diesel and jet fuel. It just depends upon the complexity of the refinery and then what the cost of that feedstock is and what the revenue that can be generated from the sale of the refined products that would be manufactured in the refinery.
I feel like back when I started to remember things, have memory, people were in a constant state of panic over the idea of peak oil. We needed to move away from fossil fuels because we were going to run out of oil, and that would cause prices to skyrocket, and we'd be at the whims of foreign oil producers. Fast forward to today, the shift to alternative energy sources seems to be more about reducing carbon emissions. The U.S. is the biggest oil producer in the world, and the U.S. is producing close to a record amount of oil every day. Can you walk us through the biggest changes that help explain this remarkable transformation over the last 20 or so years?
Yeah, it's really been innovation and disruptive technology. It was around 20 years ago when some small independent producers in the U.S. started to experiment with hydraulic fracturing and horizontal drilling. And over time, through thousands of wells that have been drilled over the last 20 years, that technology has gotten better and better and more efficient. What's really happened is the U.S. was a net importer of crude, and we were in the process of building LNG import facilities because we didn't have sufficient production. But with this horizontal drilling and the hydraulic fracturing, we were really able to rapidly grow to the point where the U.S. is the largest producer of crude oil and natural gas in the world. And that has really enhanced our energy security. It has helped to keep energy affordable and available and secure. It has also enabled the U.S. to dramatically reduce its carbon emissions because we've been able to replace coal, which was predominantly used for power generation. And so it's been the last 10, 15 years, you've seen a precipitous decline in the number of coal plants in the United States because they could not really compete with natural gas, which has surged in supplies and prices are very low. So there's been a lot of benefit enjoyed by the American people and the U.S. economy from the innovation in the oil and gas industry.
So that technological innovation that comes from fracking, why has it seemed to have so much more of a presence in the US than foreign countries? Is it just a regulation thing? Is there something about actually the natural resources in the US? Why have other countries not adopted this technology at the same rate as we have in the US?
I would say, as far as that goes, it's the United States leads in technology globally in so many different areas. We also have a very capitalist system. A lot of the OPEC countries and the like, they have state-owned oil companies, and their objective is to maximize kind of employment. It's not to maximize profit. I think the free market capitalist system in the U.S. and the ability to develop and deploy and refine and perfect technology has been a huge impact. The other parts of that were very important is, particularly after the great financial crisis, the United States economy was incredibly sluggish. Really, one of the only areas that was growing was the U.S. oil and gas industry. So you had an industry that had this emerging technology that was getting better and better. They had access to capital, and the governance and incentives for executive management were to grow. And as this technology becomes available from the super majors all the way down to the smaller independents, if people have the ability to grow through technology, the access to capital to grow, and they're incented to grow, they're going to grow. And that's really what the difference is here. Certainly, the other big difference is in the United States, the mineral rights are predominantly owned in private hands. And so companies were able to kind of engage with landowners and mineral rights owners and pay them royalties to sign a lease to develop the reserves kind of on their land. And many other countries, the mineral rights are owned by the government. So it's really a fundamental difference in our system compared to everywhere else that has enabled us to do this. Certainly in the great oil provinces all around the world on every continent, they have the rocks that have the ability to have this technology deployed, but many of them don't have access to it. For instance, if you think of Russia, the United States, and Saudi Arabia have been the largest producers for the last several years. But after Russia went into Ukraine, really all the big foreign oilfield service companies have kind of pulled out. So the access to their technology and expertise has kind of been withdrawn. So they're going to be much more challenged to grow and to compete in an environment where they don't have the latest and best technology.
You've mentioned sanctions on Russian oil a couple times, and I want to kind of take a status check there. I think to those of us who are not following the oil industry news day to day, sometimes these headlines pop up about OPEC plus production cuts, sanctions on Russia, and then there was a deal with Iran during the Obama administration that was then changed during the last presidential administration. And what is all the status of that? Geopolitically speaking, what are the kind of biggest things impacting U.S. energy prices when it comes to these policies of sanctions and agreements and what people are doing around the globe?
Yeah, I would say oil is predominantly impacted by macroeconomic risk and factors in geopolitical risk. If you go back over the last 20 years or so, really before the great financial crisis, you really had the emergence of China. I think once they joined the World Trade Organization, they were rapidly expanding their economy. A lot of companies were moving their manufacturing over there. And so China had a surging energy demand. In the summer of '08, oil prices went all the way up close to $150 a barrel. And certainly it fell back quite significantly after the great financial crisis. But about that same time is when the U.S. shale renaissance was kind of getting underway. And really what you saw was a huge increase in supply. That presented a threat to OPEC. And so what they were doing was kind of cutting back on their production and ceding market share. And then, on Thanksgiving Day 2014, they decided to reverse their policy and reversed those production cuts, and they kind of flooded the market that resulted in a collapse in prices. That pressure that was brought to bear on the U.S. energy industry really focused them to reduce their costs and get much more efficient. A similar thing happened during the COVID pandemic. We had a never before experienced massive collapse in global energy demand of around 35% in just a few weeks' time. And there just wasn't enough available space and inventory to kind of fill that up. And so prices briefly went negative on April 20th, 2020. Since that time, as the COVID restrictions kind of faded away and economic growth resumed, prices tended to go back up and get to more of a level that is really needed to sustain investment where companies can cover their costs and make a profit. Certainly after Russia went into Ukraine and briefly after the Hamas attack on Israel, there were some temporary price increases because there was a geopolitical risk premium into the global prices. But those tended to be relatively short-term in nature and did not have really a lasting impact, really because of the U.S. Having the ability to kind of grow their production, which we've been steadily doing over the last 10, 15 years. At times there's been sanctions, various countries, including Iran, but those had very little impact, again, because of the surging U.S. shale supply. And the sanctions that were on Russia after they went into Ukraine were really not about stopping Russia exporting. It was just about reducing the price that they get for the sale of those oil and gas reserves. So a lot of different things that can impact kind of prices over time from either a macroeconomic or geopolitical risk perspective.
I think that's so interesting because if you look at a chart of crude oil over the last 4 years, the big dips that you can see in that chart that stand out or spikes are the ones you mentioned. So it's the pandemic shutdowns in April of 2020. It is Russia invading Ukraine a couple of years ago. But since the violence began in Israel on October 7th, prices have been pretty stable. And so if I understand you correctly, oil prices are able to withstand a lot of this geopolitical uncertainty because of the dynamism of U.S. production. U.S. producers can fill any gaps that come from these shortages, but also the sanctions on Russia were less about disrupting the global supply and more about making a point in other ways.
Yeah, that's right. I would say another factor that was very important is OPEC plus discipline. They have enacted some production cut that has really kind of resulted in a fair production capacity that's available and literally can be kind of turned on with the turn of a knob. Since the market senses there is not going to be a supply shortage, you haven't had kind of a long-term spike in prices. Actually, if you look at the futures curve, it's backwardated, which is really the signal that the markets do not really think that there is kind of a big issue there. Kind of tangentially to that conflict, there were the Houthis in Yemen were kind of attacking some export routes, but the impact there has been relatively small. A lot of oil and non-oil cargo has had to take some longer export routes around the south of Africa, but there haven't really been any supply disruptions that would cause a price spike.
When it comes to thinking about the future path of oil prices, I think geopolitical uncertainty is inherently difficult, maybe even sometimes impossible to predict. When I look at a chart of the direction of oil prices, it can appear kind of random. So when you think about the future path, do you think about those macroeconomic factors? I guess I'm curious, when the Energy Information Administration comes out with a report weekly or monthly, do you look for anything? How do you keep the pulse of the oil market when, to an outsider, it appears to be quite random?
Well, all I've ever done for the last 37 plus years of my career is do energy lending. I read an awful lot of research that comes out from different sources, including information from the EIA and the IEA, where they're kind of providing supply-demand outlooks and the like. So there's plenty of information out there to kind of monitor these things. And so those are things that we're constantly monitoring and to try and understand what's going on in the market. There's things that impact natural gas, like weather, that tend to not have as big of an impact kind of on the oil markets. And over the last couple of winters, we have had some unseasonably warm winters that has really negatively impacted demand and has left us with really excess capacity in our inventories coming out of winter. Earlier this year, natural gas prices were significantly below $2 an MCF. What you saw there were some of the larger independent natural gas companies just curtailed their production because they didn't want to sell it into a depressed market. So you're seeing some discipline on behalf of U.S. producers that are helping to kind of bring that supply-demand balance back into a more stable situation. Companies have also been temporarily reducing their drilling rig activity and the fracking and completion of those wells. They want to make sure that they can get an adequate return on the capital they're investing, and that would kind of come with the recovery in natural gas prices, which we've seen quite significantly here over the past several months.
I want to talk now about the Strategic Petroleum Reserve. At the end of 2021, the U.S. started to draw down oil from the SPR. Can you tell us about how this fits into energy policy and how its role has changed as the U.S. has become less dependent on oil imports? What is the thinking behind the SPR, and what purpose does it serve if the U.S. is as big of an energy producer as it is now?
Well, the SPR was established in 1975 in response to the Arab oil embargo in 1973 and 1974, which really caused price spikes, terrible inflation, and severe recession in the United States. So the SPR was established and to really provide a supply buffer that could be used in response into energy supply shocks. It has not been used very frequently. I mean, in the past, when there was the 1991 Gulf War and Iraq had gone into Kuwait and blown up a lot of their oil and gas wells, reserves from the SPR were released there to contain that price spike. You've also had natural disasters like Hurricane Katrina in 2005 and Hurricane Harvey in 2017, which negatively impacted the Texas, Louisiana Gulf Coast. And there's been other situations, the Libyan Civil War in 2011. Obviously, COVID had a negative impact, and in most of those other situations, they're releasing reserves. But during COVID in 2020, the SPR had spare capacity, so they were able to kind of lease that out and take some of the excess oil production off the market because all the commercial inventories were really getting filled. The most recent usage was really after Russia invaded Ukraine. Oil prices spiked up to like $130 a barrel. So really our Strategic Petroleum Reserve was, I think it produced something like 1 million barrels a day for 180 days. And that helped contain the price spike that was happening there. Strategically, we need to refill that so that we have that supply buffer so we can respond to future events that can negatively impact our energy security and our economy from preventing a price spike.
There was a January 2022 survey of energy firms done by the Dallas Fed. I know this sounds pretty random, but for each of these quarterly surveys, they have a handful of special questions. And in that particular survey, one question was, which of the following is the primary reason that publicly traded oil producers are restraining growth despite high oil prices? And at that time, January 2022, 59% said it was, quote, investor pressure to maintain capital discipline, end quote. So it was not regulations, worries about the economy, or lack of access to financing. And as I understand this, it was probably that oil companies really saw huge losses and unpredictability earlier in the pandemic, and they needed to recoup those losses. But what I feel this survey really gets at is oil companies don't make business decisions just based on the current moment. They really think over a longer term horizon. When you talk to people in the oil industry, what are they most considering when thinking about longer-term investment in their businesses?
It's kind of related to the shift that has really happened in the industry over the past decade. Before OPEC responded in late 2014, and that led to a big price collapse in 15, 16, there was a lot of growth capital going into the oil and gas industry. There were a lot of smaller independents that ended up going bankrupt, companies that had IPO'd or had accessed debt and the institutional debt capital markets. And a lot of those companies ended up going into bankruptcy. The bondholders became the owners. So really what they did was to shift the governance structure that says we're no longer incenting management to grow, we're incenting you to return capital to the shareholders of the business. So really what that led to was a huge shift in how management teams executing their business strategy. So if you were focused on spending 120% of your cash flow and growing consistently over many years, issuing equity, issuing additional debt, that did not end very well. So I think the new owners were really bringing in this new discipline, and it started with changing management incentives and restricting the capital that would need to facilitate growth. Because if you can operate your business where let's say you're only spending 75 or 80% of your cash flow to maintain and maybe slightly grow your reserves, there's additional cash flow there that can use to deleverage the company, to de-risk it, and to either fund dividends or do share repurchases for publicly traded companies. So it's really the governance changed caused by the new owners and the pressure of the institutional capital markets that has made this change come about.
Earlier this year, the Biden administration paused approvals for applications of LNG exports to certain countries. Was the motivation behind this energy security, environmental impacts? How do you think it will impact the price of LNG for U.S. consumers, and will it have much of an effect on its stated goals?
I don't think it will be. Obviously, it's an election year, and so no matter who's in power, if they're rerunning, political matters do get added into the equation. But the U.S., we export liquefied natural gas now, and I think we started exporting our first cargoes in 2016. Today, about 15% of the natural gas produced in the country is exported via these LNG facilities, and it really helped us save Western Europe in particular after they shut down their natural gas from Russia. But the LNG industry is exporting somewhere around 13, 14 billion cubic feet a day. There are projects that have received permits, those that are in startup phase, those that are under construction, that are going to double that between now and about 2028. So the recent action by the Biden administration is going to have zero impact on those projects that are in process. So the changes that they have announced are going to impact any future new builds. And then I think they're also continuing to focus on reducing some emissions on some of the existing LNG export facilities that we have out there. So no near-term impact, but could be an issue longer term on our ability to continue to grow beyond the projects that are currently in process.
You mentioned how technology like fracking has made it so oil companies are able to increase production, increase their productivity. But there's also technology that could shift demand away from fossil fuels, which is things like the move to electric cars, not only from subsidies from the federal government, but also a potential shift in consumer demand. And so I want to end with a question about how oil companies are thinking about a potential pivot in the demand for oil or in the way that people drive their cars. So how has this push for electric cars shifted how oil companies are thinking about investing in capacity in the next decade or so?
I would say that the energy companies are all about producing energy in an economic fashion in compliance with laws and regulations that they have. It's important for people to recognize that EVs are not going to be displacing oil in anyone's lifetime. It's just not practical. There have been studies that have been put out by the IEA that basically have said there is not enough rare earth materials, minerals, to electrify transportation globally. And if you look at that supply chain, it is dominated by China. China is in areas in Africa and South America. They are mining those rare earth minerals. They're sending them back to China, where they go through a very energy-intensive process to refine that and separate that out. Then all of those materials are going to manufacture batteries. And you've really seen the emergence of China as a leader in EV batteries. Of course, the ability for them to grow their market share is getting impeded by tariffs and import restrictions and the like here in the U.S. So I think the U.S. companies are all recognize that the change in energy demand, whether it's oil, natural gas, coal, these things are going to change very slowly over a very long period of time. EVs do represent a long-term headwind to growth in oil demand, but you really have billions of people languishing in energy poverty who are going to need all sources of energy for them to kind of improve their economic well-being and move into the middle class. So I think the major oil and gas companies are very realistic, and they're going to be investing in things that are economically viable, and they're going to be doing that at a pace that is consistent with the demand for different sources of energy and to comply with regulations and laws that are pushing that policy in one particular direction. The U.S. energy companies have the technological ability to manage these huge projects and to do technology and research, and they have the capital to deploy on those projects as and when the technology improves to the point where it's economically viable, and they will continue to play a major share in kind of the development of those technologies and in meeting the energy solutions of everyone around the world.
Bryan Chapman, thanks for coming on the podcast.
All right, thank you.
That was Bryan Chapman, Market President for Energy Finance with First Horizon. I think that tremendous transformation of the U.S. oil industry, from being so dependent on foreign oil only 20 years ago to now being the world's largest producer, helps explain why crude prices have managed to stay relatively stable despite so many ongoing geopolitical risks. As long as U.S. producers can maintain some operational flexibility, they should be able to make up any shortfall that comes from OPEC plus production cuts or disruptions from sanctions. Next week, we'll see both ISM surveys for June before the employment report on Friday morning. Strong job growth has consistently given the Fed permission to focus singularly on the price stability aspect of its dual mandate, but the steadily rising unemployment rate has put some investors and even Fed officials on close watch for labor market deterioration that could encourage the Fed to move up its first rate cut. As of this recording, the consensus expectation is for the unemployment rate to remain at 4% and payrolls growth to have slowed from 272,000 to 185,000. Something else to keep in mind, U.S. financial markets will be closed next Thursday for the July 4th holiday. The following week, financial markets will be focusing on the June CPI, released July 11th. The important question is whether the steep slowdown in May continues into upcoming months or proves to be an anomaly. Along with the June PCE released towards the end of July, this will be the last inflation data the Fed will see before its July 31st decision. Chair Powell is scheduled to make 2 public appearances over the next couple of weeks, including testimony in front of the Senate Banking Committee on July 9th. We think he is much more likely to use the opportunity to emphasize the nonpartisan nature of the Fed to the public ahead of November elections, rather than signal a radical change in policy. A few Fed officials are also scheduled to speak over the next 2 weeks, and we expect that number to slowly increase as time goes on. Investors will be looking to the FOMC minutes from this month's meeting, released next Wednesday, for any clues about how FOMC participants came to their latest economic projections and how much they factored the May CPI into their individual outlooks. This Sunday, French voters will head to the polls after current President Emmanuel Macron called a snap election following his party's disappointing showing in recent elections for European Parliament. Macron's centrist party is expected to lose to the far-right National Rally Party, but it's still unclear what coalition government can be formed after all the votes are tallied. Most analysts expect the National Rally Party to push for larger fiscal deficits, but they've backed off of their campaign to leave the Eurozone that defined the party only a few years ago. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.